Well, we look at all four major asset categories because it's important to do so, because they're like tectonic plates. They're bumping into each other and they're impacting either positively or negatively. So if you're in gold, don't just look at gold. Look at the stock market. Look at the bond market now, which is saying, yep, there's some scared money starting to move out of the stock market. It's important stuff. Dollar index, for example, has been dormant as heck for 3 years now, basically in a monthly peak close to low close, about a 7% range. For 3 years. That's like a sleep. So major Forex has not been a impact factor in other markets. But right now, the dollar index is about 2% above a level that if it drops down to and closes a month at, we're going to blow an annual momentum trend structure that goes back a couple decades. Meaning our momentum work says, uh-oh, the floor is coming out. And suddenly at that point, you're going to have another major asset category become a wave creator. And it will be a wave creator that hurts many of the foreign investors who've piled into the U.S. stock market. Because when they bought through dollars to buy their stocks. And suddenly they get hit by one, stock market dropping, and two, the dollar dropping. So watch that factor, and that will impact gold as well. Back in March of last year, after almost 3 years of sideways in gold and downside staircase in silver and the miners, we argued that the pause, which is what we defined that period as, not a topping action, was over and we're going back up again. Okay, so it's March of last year. Gold was just above 2,000 again. It'd been there 3 or 4 times before, but this time was different. Silver was 25 to 26. We since seen 35. And GDX, for example, the gold mining ETF, was 31.5. It's been up over 40. It's over 40 today. But during that surge of the last 11 months now, there have been multitude of pullbacks in gold. And it seemed like every time gold would do that, yeah, it's the top, oh no, or we're going to have to correct for 6 months and, all this stuff. And if you go back in the weekend report, I put an arrow in each of those spills, the little drops that gold had. And there was one of them that was 9% and one was over 6, but most of them were about 5 or so percent. The one we just had last week, from last week's high to last week's low, which is the peak to the low so far, was 4.3. And yet people have still said, oh, that's it. 3,000 was it. We can't get through there. If you look at the price chart even and look at prior highs, when gold makes a high, even the prior highs during this last year where it drops, 5-6% or so, it takes maybe a month or two to get back up. This one had 3 weeks in a row at the same high. Within a few dollars of each other. You don't top that way. If you're going to top that way and create a correction, you create a spike and then you drop. Okay, you don't keep coming back to the same level. And so obviously there was a crowd of folks saying, okay, 3,000 is a big round number. I'm going to sell just short of it and risk a nickel and make a dime. Well, they risk a nickel and now so far they ain't made any money. We think that probably was it. It was a protracted daily decline actually for momentum, even though for price it was like a 1 week phenomenon. But I think that's probably over, that last dip, false top, and you get back to the highs again. This time I think it's going to be different in that the process we've seen all during the bull market, actually since the 2015 low, but especially over the last year, the staircasing process, we had 3 steps up for gold, 1 back, or for silver it's like 4 steps up and 2 back, will end, and that we're going into a more accelerated phase. That's what I see happening here. And I think it's going to be coincident with the breakage we're already seeing in the stock market. It's already commenced with the S&P. Some other key markets around the world, the Sensex in India is a bubble as well, and the Nikkei 225 has. So we've got 3 major markets around the world, which are all would be qualified as big bubbles, given the multiples of gains of it since 2009. And they're breaking structure. The only one we're waiting on is that NASDAQ 100. And it's dancing around the number right now. So anyway, we think the stock market breakage is more fuel for gold. Not what most people think, which is, oh my gosh, if stocks go down, gold goes down. That is not a good truism at all. We did some studies going back to that 2007 to 9 period, which is what everybody's got burnt in their memory. Yes, there was a month in that bull trend in gold, which remember had begun from a 2001, 2002 low, down around $260. So it was already in process upside. But in that 2007 period, yes, gold weekly price was somewhat in sync with the ups and downs of the S&P. And then we showed that when the S&P made its final peak in October of 2007, 1 month after the Fed began surprise rate cuts, by the way, gold was still somewhat in sync in these little weekly moves. And all of a sudden, there was a sharp break in the S&P from a November high to the January low of 2008. And at that point, when it really counted, gold shot up. So there was all these seeming linkages that you could see suddenly went sour in a big way when it really counted. In other words, when the big move occurs. And yes, during 2008 in October, a full year off the stock market's peak, the stock market produced what you could call a crash type month, 30+% on the downside in a matter of weeks. It was in October of 2008, a year after its high. Gold participated in that 1 month cataclysm and immediately reversed, or within a few months was back to its high again, while the S&P continued down until 2009. So yes, you can find a month during that 10-year bull trend in gold where, there was a month they did the same thing. If you believed that and got out of gold, you missed the entire move. It went to 1920, while the stock market took until 2013 before the S&P could ever get back up to its 2007 high. So yeah, don't make the mistake of finding points of linkage that you think are truisms, because over time they don't work out. In 29, we had a crash coming off the high. In 87, there was a crash that did not lead to a bear, and there's reasons for that. The annual momentum was not broken. It was just the quarterly. In our case, we're going to have a nightmare situation as we have both annual and quarterly in jeopardy. But the point is that it's rare to have a bear market that begins with a crash. Most of the bear markets you go back and look at in the stock market, like in the mid-70s to the 74 drop, was late in the bear market where suddenly you had a crash type event. And by the way, during that time, gold was exploding, okay? The dot-com high, there was no crash. NASDAQ 100 dropped 82% over 2 years, but it wasn't a crash, meaning a crash is like 30 to 35% in a matter of a couple of weeks. Like that's what happened in 29, that's what happened in 87. And also the COVID event was a crash type event. But don't expect that this time. I see enough reasons to see layered decline in the market. Decent drops, but not what you could call a crash. And in the past, you get those kind of events, it's not going to impact gold. Why? Because two reasons. Money in the stock market, which we know is enormous, will seek a new place. It doesn't all get burned up in the fire. Smart money starts to move. It's already begun to move. It's pretty evident. And where does it go? It goes into gold while you have a stock bear market, and it goes into T-bonds. And this time, I think T-bonds are already indicating something's going on because they're going up, and it's not because Fed's cutting rates because they don't control the long end of the market. But T-bonds are rallying while the stock market is getting nervous, and gold has been rising. So money is already flowing there. The question is an acceleration in that money flow, and that will occur once you knock them in the face once or twice. And we think the first drop in the S&P will be about a 20%er. In other words, if you look at an S&P price chart or a NASDAQ 100, I go back to the 2021 or 2022 highs. That's about 20% off the recent highs. And I think the price guys are going to want to buy that old high, thinking, it's support. And we've got momentum reasons to assume that there might be temporary support there. So what we're arguing is, yes, even if you break our key numbers, which most indices have done, except the NASDAQ 100, which is the leader, we think there'll be a slab of decline, the kind that upsets people. No, it's not going to terrify. It's not going to be a crash, I don't think. It'll be a layered process like most bear markets are. But even a 20% jolt, if you're an average Joe out there and there's one thing that makes you smile over the last year, not consumer prices, not a mortgage, et cetera, not your credit card debt, but your retirement account. Oh boy, it went up 20% last year. If all of a sudden you shave about 20% off that thing, then they don't have anything to smile about anymore. And that's when you inject emotion into markets. It's when, nothing looks good. What do I do? And that's when you'll see more money flow into gold-related, and we argue especially into the miners. We sense and know from what we've read that especially U.S. investor interest in the gold miners has never been so low in history. And their capital commitment and their leverage in the U.S. stock market has never been so high. Okay, so they're highly vulnerable to breakage in their stock positions because not only are they long, but they're like triple long. They're using a lot of leverage, more so than ever before. And therefore, there's vulnerability there. And when you look at the gold miners, when we measure like the XAU or GDX versus gold or XAU GDX versus the S&P, we see the same situation. They're very low. They've not been going lower in relative terms, despite the public sense that they have. They've not. They've really held their ground. In fact, XAU index from December 2015 to the present is actually up more than S&P is from its 2015 low. We think that could shift. And when it does, because of the nature of the gold mining sector, it would be a panic situation, which will shock a lot of gold investors because who are in the miners, more or less bored to death by them or scared to death by them every time they dip. But I think that's the reality that's about to dawn. And I think for silver, I'm using May contract now, which is a 32.40 area. You get much above 33 again, I think silver is going to start to accelerate. And if you look at the gold miners, just a simple monthly price chart, just go back to the 2015 low and look at XAU and look at GDX. Over the last 3 years, they keep coming up to the same general level. XAU, for example, is trading either side of 160. If you go back 3 years, you'll find that there's like 5 or 6 monthly closes. They're a couple percent either side of 160. That is not a top, folks. When you top a market, you generally peak it, drop, and you can't get back to the high. You keep coming back to the high indicates no, that's a launch pad. And I think that's about what's going to happen here. There's certain sectors out there that seem to be defying the drop we're seeing in the tech leadership. The Magnificent Seven are dropping now, whereas financials, for example, are making new highs. XLF ETF. We think that is a trap. We think it's a exhaustion spike in the financials that will fail. But also, I think it's probably driven by a false assumption, and that is, oh, good, long rates are starting to drop. Well, the reason for the long rates starting to drop is probably not good for the stock market. It's indicating an asset flow into a, quote, alternative sector, which has historically, go back especially the last couple of bull market peaks and bear markets, have risen while the stock market went down because investors and asset managers move there as a place of safety. And I think that's what's helping cause the T-bond market to rally of late, is the beginning breakage that we're seeing in the stock market. So it's really not a positive thing. And plus, in the past, whenever rates start to drop, it's too late. The bubble's already broken. Every time, 2000, 2002, 2007 to 2009, rates collapsed. Fed cut rates like crazy. It didn't help. The bubble broke. And I think we're on the cusp of that again.